The new Fed chair's plan to reduce the national debt's already in motion, and most people have no idea it's happening. And by the time this video is over, you're going to understand not just what that plan is and how it works, but why it's creating one of the most significant capital rotation opportunities I've seen in years. And I'm going to hint at it right now before we go any further. The opportunities in metals, not gold, not silver, but a metal that powers the entire physical world and that's quietly becoming one of the most interesting setups on the board right now. And we'll get there, but first you need to understand the macro architecture being built around you, because without that context, the opportunity does not make sense. And before we dive in, the only thing I ask in return for all the work that goes into making a video like this, that you hit that like button and don't forget to subscribe. Because every time you do that, YouTube pushes this video out to more people, and that helps us prepare more people for what's actually happening. The United States is currently carrying more than $38 trillion in debt, and by every historical precedent, the current system should already be under extreme stress and really collapsing at this point. And yet the country continues operating as if nothing is wrong. Financial markets keep hitting all-time highs while the real economy is deteriorating underneath. And the people who come out ahead are the ones who understand not just that something is wrong, but specifically what the government is planning to do about it and what that plan means for your money. So let's start with the Fed, because this is where everything begins. Kevin Warsh is Trump's pick for the next Federal Reserve chair, and the market reacted to something he said about calling for a new Fed-Treasury accord. And most people heard that phrase and either ignored it or did not understand what it meant. But if you understand what it means, you understand the entire game plan. And to understand what it means, you have to go back to World War II. Following the war, the United States found itself with a debt to GDP ratio that had skyrocketed to 121%, which is almost exactly where we are today, with $38 trillion in debt against an economy that cannot grow fast enough to outrun it. And the government was in an impossible position. It could not raise taxes enough to pay its bills, could not lower interest rates without risking inflation, and it could not just stop borrowing because spending obligations were too large. So the Federal Reserve and the Treasury reached an agreement, and from 1942 through 1951, the Fed engaged in something called yield curve control, meaning they pegged interest rates across the entire curve. Short-term bills at a fixed rate, long-term bonds capped at a ceiling, and the Fed bought an unlimited number of treasuries to keep those yields suppressed, which meant the government could borrow at rates it could afford, and the debt to GDP ratio slowly came down over the following 30 years, not because they paid the debt off, but because they inflated it away. The purchasing power of the dollar declined, the size of the economy measured in dollars went up, and the debt shrank relative to the economy. And the people who paid for it were ordinary citizens through higher prices, and that's the plan being dusted off right now. That's what a new Fed-Treasury accord means, and Kevin Warsh, despite his public reputation as a hawk who's critical of quantitative easing, is precisely the kind of person you want running this operation, because he was instrumental in getting the last round of monetary intervention started during the financial crisis. And we've seen this pattern before. People who are publicly critical of Fed policy, once they get into the chair, do exactly what the situation demands. We saw it with Greenspan, we saw it with Powell, and the situation right now demands monetizing the debt. In times like these, the best way to secure and maintain your retirement is to maintain a balanced portfolio that can ride through this economic chaos. And with that in mind, I've developed a list of the best 6 stocks to own in 2026 that you can download for free at free.stockscommunity.com. The link's in the description. If you're actively managing your stock portfolio, head over to stockscommunity.com to learn how I buy and sell stocks at the right time. I'm currently offering a completely free 10-minute training on how I spot stocks before they go up. This is the same training that one of our members watched and went on to make thousands of dollars in a day. You can view it 100% free at the link in the description below. And as always, nothing in this video is financial advice. Do your own research. Now, let me explain the specific mechanics of how they plan to execute this, because the details matter and they connect directly to where the opportunities are. The first mechanism is a remix of the Federal Reserve's balance sheet. The Fed currently holds very few Treasury bills relative to mortgage-backed securities and long-term bonds. And what they could do is offload the mortgage-backed securities and replace that with T-bills, giving the government a fresh and easy source of borrowing. But the second mechanism is the one I think is most likely and most significant, and that is bank deregulation. Specifically, the removal or relaxation of something called the supplementary leverage ratio, the SLR, which currently restricts how many US Treasuries banks are allowed to buy. And during 2020 and 2021, that restriction was temporarily removed, and banks went absolutely wild buying treasuries, which is one of the main reasons yields collapsed during that period. And if the new Fed administration, in coordination with Scott Bessent at the Treasury, removes that restriction again, banks can absorb massive amounts of government debt, the Fed can normalize its balance sheet, and the government can borrow whatever it needs at rates lower than inflation. And the result of all this is mechanically and historically identical to what happened in the post-war period. Higher prices for goods and services, higher asset prices, a weaker dollar, and a slow grinding debasement of purchasing power that transfers the cost of the debt onto everyone who holds dollars and does not own hard assets. And this is where the dollar chart becomes critically important, because what technical analysis is showing us right now is not just a weak dollar, it's a dollar that's approaching a trend line that goes all the way back to the financial crisis of 2008. A trend line on the weekly chart that's been tested over and over again. And here's the key insight about trend lines that most people miss. The more times you hammer on a trend line, the weaker it gets. Think about it like a door. You ram into it once, it holds. You ram into it again, it weakens over and over until finally the door is so weakened that the next hit breaks it through. And that's precisely what's happening to the dollar trend line right now. It's been tested repeatedly, and the hits are coming in quick succession, which is the worst possible sign for a trend line's durability. And the euro is already broken out strongly against the dollar. The British pound looks bullish against the dollar. And the technical picture across major currency pairs is telling you the same story that the monetary policy picture is telling you. The dollar is in the early stages of a structural decline, and the yields are confirming it, because the 10-year yield is also approaching a major trend line from above with the same pattern of repeated tests in quick succession. And when yields fall now in 2026, it's not the good kind of yield decline we saw in 2019 or 2020 when the economy was still perceived as strong and the Fed was just normalizing. This time, yields are falling because there's genuine fear that the economy is slowing, and falling yields because of a slowing economy means falling corporate profits. And falling corporate profits means the S&P 500 at its current valuation of roughly 22 times earnings becomes very hard to justify. Now, layer on top of that the private credit situation, that's the crack in the foundation that most people are not watching closely enough. All this is directly connected to everything we've been just talking about. Apollo's mid-cap financial investment Corp just cut its dividend and wrote down its net asset value. KKR reduced its dividend after an increase in troubled loans and lower investment income on a $13 billion portfolio tied to private equity-backed mid-sized companies. BlackRock's TCP Capital is cutting its dividend. Blue Owl's down over 60% from its peak and falling further. And the connection between private credit stress and the broader economy is a chain reaction that goes like this. Private credit funds lose money on their software and technology deals. They cut dividends and mark down assets. The big banks who lend to those private credit intermediaries start seeing losses on those loans. Credit tightens across the economy. Corporate spending tightens, layoffs accelerate, consumer spending, which has already been running entirely on a declining savings rate, hits a wall, and the whole system seizes up. And what makes this particularly alarming right now is the consumer data that's starting to emerge showing something deeply concerning. Personal spending has been going up while personal incomes have been flatlining. And the only way that's mathematically possible is if the personal savings rate is falling, and it is falling, collapsing from a recovery peak in early 2024 and falling every single month since Liberation Day with no up months. And the savings rate can only compress so far before spending has to fall. And when spending falls in an economy where the consumer represents 70% of GDP, the negative feedback loop that the Citrini research scenario describes becomes not a thought exercise from 2028, but a present reality of 2026, because What Societe Generale is arguing is that we are heading for an AI-related consumer crunch where real incomes hit a wall, consumption falls, and the one thing still holding the economy together, which is AI capital expenditure, representing a few percentage points of GDP, is not nearly large enough to offset a consumer rollover. And the Fed knows this, which is why markets are pricing in 2 rate cuts before year end, even as producer price numbers are coming in hot, even as inflation remains sticky near 3%. And the Fed's in the exact impossible position the yield curve control framework was designed to solve. You cut rates, you risk stoking inflation, you hold rates, you walk into a credit tightening bomb, a labor bomb, and a consumption bomb simultaneously. And the answer to that impossible position historically has always been the same. You inflate the debt away, you debase the currency, and you let hard assets absorb the purchasing power that the dollar is losing. So, what did I miss? What would you push back on? Let me know in the comments below. And if you're managing your portfolio independently and want to know how I spot stocks before they go up, watch my completely free training at stockscommunity.com, where I go over the same methods I teach my students on how to find the best stocks, spending just 10 minutes a day in front of their computers. And if you already have a portfolio and want to make sure you're in the best stocks in the market, download my best 6 stocks to own in 2026 for free at free.stockscommunity.com. Now, I want to close by bringing everything together and pointing you toward what I believe is one of the most specific and compelling opportunities sitting inside all of this macro chaos. And it is in silver, but not silver, the commodity held in a vault. I want to talk about Southern Copper Corporation, ticker symbol SCCO. And here's why this name sits at the intersection of what we've talked about today. It's not just copper. Southern Copper is one of the world's largest copper and silver producers in the world, operating primarily in Mexico and Peru. And, again, understand that SCCO produces both. The silver comes as a byproduct of its extraction. And the reason this matters is because silver is doing something that veteran metals watchers have been waiting decades to see. So the physical market is beginning to take command of the pricing mechanism away from the paper markets. So for the past few months, the physical silver market, specifically the market for 1,000-ounce commercial bars, has gotten tight enough that real price discovery is starting to happen outside the paper derivatives complex. And the CME has had to halt trading while contracts were settled over the counter in ways that suggest the paper paradigm is starting to crack. And the gold-silver ratio, which historically has ranged as low as 30-1, is currently sitting around 60-1, meaning silver is dramatically undervalued relative to gold even after its extraordinary run. And if that ratio compresses back towards historical norms, even without gold moving, silver would double from current levels. And there are structural reasons to believe that compression is coming that go beyond just the investment demand story. Silver has massive and growing industrial demand that's not going away. It's going up. Every solar panel requires silver. Every electric vehicle requires silver. Every piece of grid infrastructure being built to support the energy transition requires silver. And the same AI build-out that's disrupting software companies and displacing white-collar workers is also driving enormous demand for the physical infrastructure that runs on silver and copper. And Southern Copper is positioned to capture both of those demand streams simultaneously because its operations produce copper for the AI infrastructure build-out and silver for both industrial and investment demand that's accelerating as the dollar weakens and monetary debasement becomes the official policy of the United States government. And here's the specific reason SCCO stands out from just buying silver directly. Southern Copper has one of the lowest cash costs per pound of copper production of any major miner in the world, which means its margins expand dramatically when metal prices rise. It has a strong balance sheet. It pays a significant dividend that rewards you while you wait for the macro thesis to play out. And it has exposure to both copper and silver, which are two of the metals most directly leveraged to the infrastructure build-out, the energy transition, and the monetary debasement story all at the same time. And in a market where the equal-weighted S&P 500, it's near all-time highs, while the market cap-weighted version lags, where energy's up 23% year-to-date, where gold and silver are up 19-20%, materials are up 16%, you're watching the rotation happen in real time, and SCCO sits directly in the path of that rotation as a company that produces the two metals most needed by the world being built around us, owned by an operation with the decades of mining experience and some of the richest copper and silver deposits on Earth, trading at a valuation that does not yet fully reflect what a weaker dollar, a new Fed-Treasury accord, and accelerating physical demand from both the energy transition and monetary debasement are going to do to the price of the metals it pulls out of the ground. So, if you found this information valuable, smash that like button, subscribe to the channel, and share this video with someone who needs to hear it, because the people who prepare themselves and stay one step ahead of the everyday person will always come out ahead in the long run. Thank you for watching. Check the link down below, and I'll see you in the next one.